Mohit, beyond debt funds, there are several funds that fall under the ambit of this proposed change, but there are also several hybrid funds that will slip out, that will still continue to have that LTCG 20% with indexation benefits. If you can list that out, and do you think that hybrid as a category, and particularly conservative hybrid, because I think a lot of them will manage to have more than 35% equity, even if they have 36% equity, they won't fall under the ambit of this. Do you think that there will be more attention to this category?
Thank you, Alex. Always a pleasure to be on your show. So, look, I think in terms of categories which will get impacted, number one, obviously, we have all spoken about the debt category where there is zero equity, right? The second biggest category, to my mind, is the international funds category, which is all your offshore investments, which are mostly in the form of FOF, and any which ways the regulation is very clear about investments in domestic equity, right? So, anything which is not domestic equity was either ways getting categorized as fully debt in terms of taxation, and now they will lose the indexation benefit and will make this category relatively more unattractive. Honestly, I think that's been the intent also from RBI's end. If you see, the limit was busted long back, and they've not increased the limit because of the pressure on currency. And I think this will further whatever minuscule the component might be, this will further stem some outflow and perhaps might help the currency. I'm not the right person to articulate that, but yes. The second category which will get impacted is the commodities category, which is your gold and silver funds, which have ETFs, gold and silver fund of funds, which have of late picked up some steam. Again, I think the intent out there is mostly that the diversion of investments in gold has to be through SGBs, which is the most preferred route for government per se, and I think that's more beneficial for investors also in the long term. So but yeah, the categories will get impacted. There was a lot of retail money, a lot of SIP money which was flowing in out there. SGBs, as you will know, it will only come one tranche in a quarter or so. You need demat accounts to do that, and there are certain, and you have a fixed tenure and all. Mutual fund format was always more preferred from a retail investor viewpoint. So I think that becomes a little unattractive.
But do you think that because of this change, or once this change, if it does take place, just very quickly to make that point, do you think people will shift out of fixed income currently and move to hybrid to get that tax advantage, or do you think that that's not something that will happen?
Looks, I was coming to that. Honestly, if you see, Alex, the overall debt market in India is roughly around, let's say, 14 lakh odd crore, out of which predominantly it's in market. 30% is approx around HNI market. Now, that is the one place where the maximum impact will be felt. Corporate money, any which ways, or short-term money, was never meant to be more than a 1 year kind of pocket. So that money, will it move to conservative hybrid or an equity savings product or an arbitrage product? Perhaps yes. I think tax arbitrage was a huge opportunity. Look, you lose one very big, fighting point against a fixed deposit, and a lot of money might perhaps move to fixed deposit. But you still have one more ace up your sleeves, which is that the loss set off or the capital gain set off is only available to mutual funds. That's not available to FDs, right? So you continue to have some advantages of investing into a debt mutual fund or into any kind of a mutual fund, because you get that loss or a gain set off thing. But to answer you very specifically, I think a lot of money might move into arbitrage, equity savings, and conservative hybrid as a choice. But will that meet the asset allocation criteria strictly, or personal finance point of view? Is it the right way to do it? I will still have to figure it out, because you finally are giving some equity composition.
Fair point. And as we speak, the finance bill has been passed. Now, I'm searching for clarification as as we speak, whether it is as it was suggested or the amendments, and I will come up with exactly what it is. But as of now, what we're hearing is that the finance bill has been passed. Now, again, assuming that this is the case, Gurmeet and Mohit both, I'll come to you, Mohit, first. To the point that Gurmeet was making earlier, there's going to be a rush to mutual fund schemes because this kicks in 1st of April. And therefore, you shouldn't buy just because there is a tax angle. Of course, you should pay attention to your financial planning. But is there an advantage to buying, say, and if you look at the debt yield curve, you're talking about 3-4 years being the sweet spot. Is there an advantage buying into mutual fund schemes that are debt oriented, and which would you suggest people look at?
So look, Alex, yes, I firmly believe that you should not be basing your investments just on the tax point. It has to meet your long-term goals. But honestly speaking, for last couple of months or last quarter odd, we have been fairly bullish, and we have been asking our clients to move their allocations to long end of the curve. Look, the curve is totally flat. Right from 3 months up till whatever 30 years, you see the difference is hardly 40 bips across both the spectrums, right? But having said which, we all could kind of conquer that interest rates might perhaps go up by 25 to 50 bips more, but next year onwards we will see a rate reduction cycle or a rate softening cycle, right? And if that be the case, then investors getting in now on in the long duration bond funds or gilt funds per se, which have like more than 10 years kind of more durations and maturities, I think those will immensely benefit over next 3 to 4 years. Added advantage, of course, is that if you invest before 31st of March, you will still avail the indexation benefits. The returns will be highly tax efficient if you count 10, 15, 20 years of indexations and you continue to hold those long-term bond funds. So both from a merit perspective and from the tax efficiency perspective, I think the returns will be very attractive for investors who get in. And it's kind of a nudge, which perhaps sometimes as even advisors, we be a little soft and we say, okay, abhi nahi 3 mahine baad kar lijiye, aisa kuch, it's not rushing somewhere. But now I think that urgency kind of kicks in to everyone, and it's good for the entire ecosystem from that perspective. But yes, investors should lock
The
in.
last opportunity to buy a debt mutual fund with indexation benefits comes with an even sweeter spot where you get 4 indexations.
Yes.